A new way to trade volatile stocks, including Tesla and Nvidia. Single stock ETFs hitting the marketplace this summer, designed to make shorting simpler for active investors. But do the risks outweigh the benefits? Let's get some answers from Tom Lydon, the vice chairman of market analytics firm Verify. Tom, great to see you.
Hi, Melissa.
Why do we need these ETFs when there are the stocks themselves that you can trade, or options?
Yeah, short answer is it's more optionality for individual investors, sophisticated traders who don't necessarily want to use all their cash that they have on the sidelines. They can get some leverage. They can also go inverse. And, most investors have to fill out margins and options agreements in order to do that. It's a great way for them to hedge, but you have to watch it every day. It's also a great way to get hedging instruments for financial advisors, as the market's been really volatile, and the stocks that these represent are some great opportunities to pick them up off the bottom, or if you're not happy about them, you can buy the short side without having to do any margin.
But when you're talking about hedging, you're not talking about using the leverage products, because the leverage products you would not, ostensibly, you really shouldn't hold them for more than a day. Am I right?
No, you should. You're right. So you guys were just talking about chips and earnings and things like that. So if these products, like they represent NVIDIA, if you feel like earnings are going to go south, you can go in for a given day, and on the Access NVIDIA Bear ETF 1.25 to the negative, you can get that leverage to the downside and short by using ultimately a long vehicle.
Tom, are these trading vehicles, to Mel's question, or are they vehicles for professionals that are, hedge funds that are trying to get that leverage? Because it sounds like for the average everyday investor, these could be dangerous, for lack of a better word.
They could. So, Guy, you're right. It's not for the average investor, although ETFs, for the most part, have been. They continue to evolve to try to grab more of the marketplace. But listen, you're absolutely right. They are aggressive in nature. They have to be traded almost on a daily basis. But for some investors that are sophisticated, or advisors or institutions, they come into play because it wraps everything up into one ticker.
Hey, Tom, it's Steve. So
Hey,
just
Steve.
a couple of things, just to piggyback. The other issue is they're based on a derivative which decays. So you have the fee of the ETF. It resets every day, and you have the decay of the derivative that it's actually based on. So just to piggyback what was already said, though, it's got to be a day event that you're trading, but it doesn't come with a disclaimer that if you hold it longer than a day, you're actually decaying your money.
Well, you're right. So there's almost reverse compounding that's built into this, Steve. However, let's just say there are companies like ProShares and Direction that have had inverse and leverage ETFs out there for 10 years. Look, we all have to be responsible in what we're buying and selling. And we know, yes, the SEC is looking at this. FINRA has this complex product rule out there right now under review. They would like to be able to put some guardrails on for average investors buying in their brokerage account, or make them go through some type of training, or make them go through more disclosure or things like that. But ultimately, as investments advance, you got to give credit to the average investor to do their due diligence. And if they're not comfortable, if they haven't looked under the hood, they should run in the opposite direction.
Tom, thanks. Tom
Thanks,
Lydon
Melissa.
of Verify. So, Karen, again, these are single stock ETFs, some of them leveraged to varying degrees on volatile stocks. As a professional hedge fund manager, would you use these as vehicles, or would you opt for other ways, like the options market, for instance?
What could go wrong? Really, Missy, right? What could go wrong with this? We've seen a couple times, the volatility index or whatever it was. We saw the USO, which is, I know, maybe a little different animal because it's got different parts of the oil complex, but or oil contracts going out. It just seems like, if you're a sophisticated investor who can understand the downsides of this, I would think it would be easier to create it yourself. Just my guess.
Right. Tim?
First of all, I mean, Tom Lydon's been a godfather in the ETF space a long time. I think the idea is that the ETF space continues to evolve and continues to dominate. And on some level, the retail investor is given more tools that institutions have. Look, institutions can create baskets and options very quickly. They have the ability to single short stocks. A lot of retail investors can't even short stocks based upon the platform they're on. Everything we've said so far, though, is absolutely true. I say buyer beware, do your work, even with main ETFs. Understand what's under the hood. These leverage ETFs, we've talked about them for a long time. I think they are dangerous. But if you know, and if you are tactical, and if you are in and out, and you are right, obviously that's what it is. It's leverage.
Yeah, Grosso, you've used these, actually.
I've actually used these. So for as long as these have existed, I've used them. Clients have used them. And the biggest issue is, no matter how sophisticated the institution or the trader, traders don't realize that they're one-day vehicles. So it decays. That is the biggest problem that I have with them. If you can tell people you're only using these for 6.5 hours during the trading day, I have no problem with it. But most people are not going to follow those instructions if they are not notified. And there's nothing on these ETFs that tell you that it's a one-day thing.